Hey everyone, welcome to 2026. Charlie and I are here today to share with you a monthly as well as an annual recap of our Managed Future Strategy, ticker is CTA. Super excited for what's ahead in the year. We've seen a lot of tremendous growth in CTA over the last 12 months. I'll mention that in a second here. But thanks for tuning in. This is our monthly recap of positioning, performance, and broader kind of macro and market backdrop as it relates to trend following. So as usual, Paisley Nardini, PM, as well as strategist on CTA, and Charlie McGarrah, who's the Chief Investment Officer at Altus Partners, who is the sub-advisor, or technically futures advisor for CTA. Some quick comments before we get into kind of the state of CTA today. Would just like to thank all of our investors who have supported us really since inception and especially over the last year. It's been an interesting year for trend following, and despite some of the rockiness that we saw in, say, second quarter and such, CTA continued to grow. So we started 2024 at about 445 million in assets under management, and we ended the year just shy of 1.2 billion in AUM. So we again just like to thank all of our investors for their support. As we think about performance for the total year, again, we'll talk about some of the ups, we'll talk about some of the downs, but at its core, CTA continued to deliver low correlation and even uncorrelated returns to both stocks and bonds, which is the key objective. So with that, let me share my screen and we will dive into the good stuff. Right. So let's take a little bit of a snapshot here. 2025 year-end closing, looking at the since inception returns and the strategy. CTA has delivered 8.33% annualized return, which is a excess return over the official benchmark of about 7.2%. So very delighted to share with you long-term, strong, absolute, as well as relative returns. But more importantly is that kind of that second set of data, which is the correlation to some of the broad traditional markets like the S&P 500, where CTA is at a negative 0.22 correlation, as well as the aggregate bond index, where we've had about a negative 0.35 correlation. And then we oftentimes get asked the question, with CTA being unique in the sense that it is just invested in interest rate and commodity futures, is this redundant to my commodity, strategic commodity beta? And you can see here the correlation that CTA has had to the Bloomberg Commodity Index is essentially flat for the since inception period. So still providing diversification despite the fact that we have commodity exposure. And then really just highlighting the use case for CTA besides that low correlation for diversification in a broader portfolio, the ability of CTA to deliver attractive positive returns in months where the S&P 500 has been negative. You'll see here since inception, the average monthly return is about 2% when the S&P return is negative. One other comment I wanted to make, thinking back on 2025, was the ability of the strategy to evolve with the broader market set and evolve as the fund has grown. So in November, we added additional markets in developed countries in Europe as well as the United Kingdom. And you'll see here across the total list of tradable markets that CTA has access to now is over 50. We remain solely in interest rate and commodity futures, so this new inclusion of markets did not start to add equities or even FX, and that is one of our key differentiators, I would say, relative to the pack and trend following. And we'll talk about how that can work for and against the strategy in a year like 2025. I think more importantly as well, kind of going back to the crux of why allocate to a low correlated asset, you'll see here the white line is CTA, and this goes back to the inception in early 2022, and the orange line is a 60/40 portfolio. And so oftentimes I say it doesn't matter as much which one is on top, although CTA has had strong returns since inception, but it's the co-movement of these two together. And you'll really see the diversification benefit relative to a 60/40 portfolio. When the 60/40 ebbs, CTA has been in kind of more of a flow state and vice versa. So really just showcasing from a visual perspective the importance of that diversification and those low correlations I mentioned prior. So let's start to move closer to talking about some of the recent performance. You'll see on the far left, CTA maintains a 4-star Morningstar rating in its systematic trend category, which has about 62 other constituents for the trailing 3-year period. And our return ranking is in the top quintile still. So you'll see we're in the 15th percentile versus those 62 peers. So maintaining that long-term attractive absolute and relative performance. And then you'll see for the quarter to date period ending 2025 year end, CTA is that white line. The orange line is the broad industry benchmark, the SocGen CTA index. And we'll, as we mentioned here, if you guys want to go back to the November episode where we highlight October performance, you'll see some of that performance drawdown at the beginning of the quarter in cattle feeder and a little bit to gold. And really since kind of that drawdown in mid-October, we've performed in line with the broader benchmark. So maybe with that, I will pause for a moment and bring Charlie back into the conversation. As always, we like to highlight recent return drivers as well as detractors. So Charlie, if you wouldn't mind sharing with our listeners just some of these anecdotes that you'll see here on the slide.
Yeah, I think for the month, the story in the main event in commodity markets is just precious metals. It's been a wild ride. Silver having blow off tops, and then finally PGMs or platinum group metals catching up. So you kind of have this order of operations in the market taking action over the last 2 years on this sort of question: are precious metals investable? And gold is the first thing, and it's sort of the granddaddy asset in that complex. And then people start buying gold, and then silver lagged and lagged and lagged, and then suddenly it's like, oh gosh, here we are. And then there's an element in the market of people going, oh well, I mean, if silver is moving, what else can I get exposure to? And it's really hard to make platinum and palladium. There's not that many places on planet Earth. It basically comes from meteor strikes on the ground, and you're digging it out with a little chisel or whatever. So it's hard to make it. So when people want to buy it, there's not going to be that much more supply. And so it's a kind of a thin funnel versus large financial flows. And it's just a question of when do people care? And it seems to have moved on. And so um, metals got pretty wild. We saw a pretty strong draw up in most of the quarter. Most of the month in December, and then some pullback right toward the end as positions got squared and volatility got really stupid there. And I think that was kind of the main event. Uh, the livestock markets continued to be active and wild with a mild positive performance, and then um, really the grain markets just not quite working from a trend following perspective, and holding it back a little bit. And then finally, our move into European interest rates feels a little bit ill-timed. European rates did not do that well, and we had some positions that underperformed a little bit in December. But statistically speaking, I feel great about having those additional diversifiers in there, and I think it will add. This is an opinion, of course, forward-looking opinion, but I believe it will add meaningful uplift in risk return characteristics for the strategy going forward by having those diversifying degrees of freedom. So pretty straightforward, but really the story was metals, and it was a little wild. Now, when I look on the rest of the year is basically broken into two halves, although the half split in the middle of April, which is pre-Liberation Day and post-Liberation Day. Liberation Day being the announcement of the tariffs. So trend following worked pretty well into that, and then you had a massive counter trend reversal, as we know, in April. And our research suggests that this pace of counter trend reversals in 2025 is quite extraordinary. And it makes sense. The administration was trying on the levers of power for size, and iterating through a whole bunch of decisions, and they got pushed back in certain places and then proceeded to change their minds. And then the other thing that was crazy is that with Liberation Day, global growth got re-rated really a long ways lower, and the stock market really took it on the chin, as did commodity markets. And what sort of stands out over the rest of the year is that if you put on a pro-growth bet in equities, from the low tick in April, that was like an amazing outcome in the rest of 2025. But if you put that same pro-growth outlook on in commodities, it basically didn't work. Base metals and precious metals work, but precious is sort of levered to anti-growth as much as growth. And base metals work, but not as well. But more importantly, energy just didn't work at all. oil has been in a sort of a supply side glut story, and the concentration of leadership in the stock market has meant that it's not really a global growth trade as much as it's been a sort of AI capex trade. And that meant that not having exposure to equities in this diversifying thing, uh, I believe, led to some episodic underperformance versus the industry benchmarks, where I think it's probably a safe kind of hand wavy characterization to say that the rest of trend following space was basically long equities and long gold, uh, quite pro correlated to the stock market, um, but probably had a smoother ride in the second half of the year. And looking ahead to 2026, I guess my view is that commodities are likely to be a better expression of global growth upside than equities. Equities are fully valued, and the market's convinced that the energy market can't get up off the mat, that there's this oversupply glut, and I'm just not like a believer in that whole thesis. I don't think Venezuelan supplies will come online very quickly, and now everybody has an incentive to stockpile because there's geopolitical risk, and so for that reason, I could see the energy market catching a bid, possibly, and becoming a more potent expression of the positive global growth view that still seems pervasive in the market. We shall see.
Maybe a quick question for you, Charlie, is thinking about 2025. I would say coming into the year, there was a lot of talk about, will bonds be the ballast? Will they continue to see headwinds from inflation pressures and, debasement trades, et cetera? What we
Yeah.
saw, though, was that both stocks and bonds, really traditional assets broadly, performed quite well. And even like you said, gold, which tends to be an anti kind of growth, recessionary type asset, performed exceptionally well in addition to traditional assets. So thinking about 2026, do you anticipate more dislocation in asset performance? In a sense, I guess what I'm trying to say is, do you feel like 2026 might be quite different from an asset return perspective from 2025?
I do. Let me break the bond specifically question out from that more general question. So to answer the general question first, I do think 2026 will be a good year for trend following. Of course, I'm talking in my book. It's my business. If I didn't think that, I probably wouldn't be in this business. But also, I think the administration has worked through their priorities. Now they're going to lean on what they need to lean on and try to win the midterms. And trend following is all about fundamental change getting priced by the market, and it seems like there's a lot of fundamental change happening after kind of this iterative design phase. And so I think this is the year of high signal versus noise and a lot of things happening in the lead up into the election and then after the election. I think the fiscal impulse will be high. The bond curve will probably be pretty steep with financial repression. The market's going to be really focused on the ongoing independence or otherwise of the Fed and the appointment of the Fed chair, and then the election. And so I think there's a lot there on the U.S. side, and then the rest of the world is sort of this question of how coherent will the pushback on this American assertiveness happen, and how the market price that. And I think the answer is we're going to see quite a lot of pushback across the rest of the system in various ways. Um, so that's the answer to that question. And then on the bond specifically, yeah, again, I think it's a case of how's the Fed transition going to play out and how much financial repression is there on the front end. I mean, I think it's really interesting that yields rallied a lot into Liberation Day, and then after Liberation Day, they've just been noisy and haven't moved. And it says something really meaningful about the flows in the market around people attempting to diversify away dollar exposures, maybe reinvesting in other jurisdictions. It also says something about people can't quite wrap their heads around exactly how much governance change there's really going to be in the U.S. monetary system. And, I don't know. But what I do know is that these flows are astronomically large, and the government needs to finance a lot of debt.
Yeah.
So it's either going to get monetized or it's got to get priced, and one of those two things will happen, or maybe both with a curve steepener. So we'll
Yeah.
see.
Well, maybe in closing, I would just mention again, one of the key differentiators of CTA, not only, of course, is our partnership with Altus, which manages their own hedge fund business. So we're very grateful, I would say, to have access to their algorithm that drives our daily positioning as well. And within that, the main differentiation being that we've isolated our exposure to interest rate and commodities. And so we often get the question, managed futures trend following being a higher dispersion asset class. we do pair or complement nicely with other trend following strategies. And 2025 also broadly from an industry perspective was a big year for trend following growth within strategies. We had some of the largest asset managers come to market, which I think just provides more credibility around this becoming a core part of portfolios for that key objective of diversification. If you think about the liquid alt spectrum, managed futures tend to provide the most attractive correlation profile, meaning the lowest with the greatest return potential. So I do think that that continues to just establish credibility of this becoming a growing part of the market. And I might
Paisley,
also, yeah,
can I just add one? I
please.
interrupted you, and I apologize, but I just want
No,
to
go
add
for
one
it.
point to build on what you were saying and kind of validate it, which is as AIs and LLMs and so forth become more pervasive, it's really not as difficult as it once was to wrap your head around what some of these active products do. Because you can have whatever conversation you want with Claude or Grok or ChatGPT and make the black box a little bit more transparent. And I think what we seem to be seeing in the flows in the client base, and, you might know this better than I do, but even I kind of see this as like an increasing focus on what these strategies do in terms of a portfolio composition
Yep.
effect, as opposed to how do they work. Because you can see the results. And then if you do want to open up that black box and understand it, you can have a very long discursive conversation with an LM and get a pretty good sense. Uh, and of course, you're always welcome to call me and Paisley. So
Always, yes. Charlie
yeah,
is very accessible for those that do not know that. He loves to get on calls with clients.
love
He
it.
can get in the weeds, as you've seen. But the Altus Partners is broadly always accessible, and that's why they've been such a wonderful partner for us. And I might actually mention on that partnership comment, we launched last month, so in December of 2025, we launched another version of CTA, which is unique. It's another way to really access CTA. So I would say one of the common concerns that investors have when they allocate to any asset class or strategy that has a low correlation of returns is when we have environments or years like 2025 where equities continued to melt higher, and then it becomes kind of this line item conversation when you're talking to your clients. Why didn't this strategy perform as well as my S&P exposure? So the way that we've remedied that is by launching a sister strategy to CTA, which is CTAP, and CTAP provides 100% exposure to CTA and then 100% exposure to the S&P 500. And so you can start to see how this then carries that equity beta, but then provides that low correlation exposure to trend following on top. And then I would also say too, this provides a different way to think about funding the allocation. So typically, when it comes to CTA as a standalone strategy, oftentimes clients will allocate to or fund the allocation from their bond portfolio because it becomes that bond diversifier. So now that we've stacked this return stream with S&P, you can start to source this or fund this from your equity exposure. And just another way to think about diversification and giving your clients access to low correlated exposure without sacrificing the upside equity beta. So I just wanted to highlight that. If you guys have any questions, you can go to our website. Again, the ticker on that is CTAP. Just a continuation of our partnership with Altus and giving our investors new ways to access some of these trusted and true strategies that we've brought to market. Anything else, Charlie, from your perspective?
I think I'm good, Paisley.
Okay. Well, thank you everybody for tuning in. This month was a little bit longer because we wanted to talk about the full year performance. Again, thanks everybody for your support. We're here if you need us, but otherwise, have a wonderful 2026.